Good afternoon, everybody. I hope you had a great lunch. I am excited to be here. More importantly, I'm excited to be here with the person who I'm sitting next to because when you're in fintech, you're in financial services, the regulator who is probably most active is Rohit Chopra at the CFPB, really looking for ways to work with industry, but most importantly, protect consumers. My name is Phil Goldfeder. I'm here from the American Fintech Council, and we're delivering for our members and their customers by leading and advocating for responsible, transparent companies changing the future of financial services. And as a trade, it's critical that we bifurcate those who promote competition, consumer protection, financial health, inclusion, equity, and those who simply don't care. And unfortunately, they exist. We're committed to those standards, and we appreciate your work at the CFPB on behalf of our members. Let me just say, long gone are the days of financial trade associations who oppose every regulation just because it advances change. We're here to work for that change. I think every company that's here at Fintech Nexus believes in changing the future of financial services, but that can only happen when we work in concert with regulators like yourself. And so with that, I want to say thank you very much for being here. You have been very, very active. Last fall, you announced an effort to bring open banking to the U.S. by conducting rulemaking on Section 1033. 1033, if you're in fintech and you're paying attention to regulation, 1033 of the Dodd-Frank Act is something that we hear a lot about lately. Can you talk about the basics? What are you trying to achieve? How can fintech be a partner, and how do we get to a better place in protecting consumers?
Yeah, ultimately the lodestar for me is I just want to see a consumer finance world where people aren't stuck, that they can switch more easily and they can take their business elsewhere. They can fire a bank that is providing them bad service and go to someone who actually will provide them that. I think we want to make sure that while we create that competitive market, we're also not creating an underworld of abuse and misuse of personal financial data. And I hope that we can all agree that the way we'll see more progress is a more decentralized system, a more open system, and a way that is not just catered to the incumbents, but catered to the firms that don't exist yet, but always with the consumer in mind. So we're going to be proposing rules this year to help, in many ways, accelerate the existing efforts, but also to make sure that big incumbents can't block new players from getting in the game.
And has the timing changed since you started this process where we stand today?
No, I think you'll see our rules finish next year, but there's a lot of work for this community and others to do in the meantime. You know, one of the things is you can't expect the regulators to get all of the details on standards, standard setting, what types of technologies are going to be used. You're going to see us try and create rules that are more timeless and that there can be standard setting by incumbents, by challengers, by consumers in a way that is fair and in a way that the regulators can point to and have confidence in. So I think many of you need to think about what are those industry standard setting organizations going to look like? Who is going to be creating those rules? Many of you may be familiar with the ACH system of moving payments. You know, many people complain that the rules around that set by industry are totally tilted in favor of the largest banks. That's what we want to avoid when it comes to open banking.
And so I've complimented you on this backstage. I mean, the CFPB has been aggressive in their outreach to the community. You being here is just another testament to that, and we've seen you talk a lot about sort of working with fintech companies. A lot of the people in this room are third-party providers. Can you talk a little bit about how third parties fall into the category as it relates to data privacy and how you envision privacy, data security, and what the CFPB expects fintechs in terms of how they treat consumers?
Yeah, one real vexing problem for regulators is maybe a lot of people in this room are focused on how to provide better services, better products to consumers in their financial lives. Some people might see an open banking ecosystem as a ruse on which they can surveil people, take very detailed transaction data, and frankly use it for other purposes. surveillance-based advertising, things completely unrelated to financial products. We're going to have to figure out, how do we stop that? One of the things we're thinking about is some real limits on third-party, secondary uses of data outside of financial services. We're going to need to think about who gets to be able to get that data, and how do we make sure we know who they are so that we can properly police them. We have learned a lot from the European Union, the UK, others, and we don't want the early years of any open banking world to essentially be polluted by scammers.
So in the banking world, we often hear the word stickiness, right? The stickiness of customers, the stickiness of your consumer. In talking about creating competitiveness, sort of how are we pushing back against that to ensure the consumer is actually getting the best product, not just because he's at a bank that's that he doesn't have the opportunity to switch over, or at least not do it easily?
Yeah, I generally think consumer stickiness, when it's high, it should be a function that pricing is good or that service is good, not because that it's so damn complicated to switch. And so I think what you see a lot in banking is it's a bureaucratic nightmare to switch your products, move your money. We often see investors talking about prepayment risk. I want to see a world where people can refinance their auto loans, their mortgages, move their credit card debt more easily. That will decrease stickiness, that will increase prepayment risk, but that's a world that I think ultimately is still better.
And so, again, and we talk about innovators in financial services, we're seeing many, many new products. Last year, you put out a report on buy now, pay later. Can you talk about what the results of those reports are? And again, as a trade, we find it important to bifurcate actors within a system. We represent members who believe in disclosures and ensuring there are consumer protections, and we're offering better products. Can you talk a little bit about the report and sort of what do you think the next steps are?
Yeah, I think buy now, pay later is part of a broader trend of trying to offer different types of products outside of credit cards. Our report ordered data from many of the largest firms, and we've actually produced a series of analyses on it, including where people get into trouble, what kind of merchant categories are being used. We did find that the talking point that buy now, pay later is some big boon to those who would otherwise not be able to be served by the financial system was largely untrue. What we did find is that those with buy now, pay later loans are also very likely to have other types of credit. So it's really like a competitive alternative. So we want to make sure that buy now, pay later is not built on any regulatory arbitrage, that it has some of the same protections as a credit card, especially when you return a good, when you have a dispute. We want to really make sure that fees are reasonable. So you'll see us do more to try and make sure that buy now, pay later becomes more of a race to the top than kind of a race to the bottom. You're starting to see across the buy now, pay later market that it's not just people taking out BNPL loans by going on a big retailer's website. More and more, you're seeing people borrow through proprietary apps, essentially creating personalized shopping experiences. So we're really looking into what is all this data that's being harvested about people and how is it being used. So I think the overall tone of the analysis in the report was that we think buy now, pay later is here to stay. We just need to make sure that it's on a level playing field.
And do you agree? I mean, do you think that there is a way to reasonably differentiate sort of those companies that are doing it the right way versus those companies who clearly aren't?
Well, we've asked the buy now, pay later industry to see who wants to volunteer for examination and oversight. That's going to be a big indicator for us of who's just talking about being transparent and who's actually really following the rules.
So with the new, we talk a lot at the AFC about regulatory modernization. Is there a way to look at some of the older rules maybe that were created for credit cards that can now be translated into some of these newer products?
Yeah, some of them. I mean, generally speaking, financial regulations, before the CFPB was founded, it was pretty tilted toward the big incumbents and banks, often very, very complicated and prescriptive, rather than bright lines, rather than clear limitations. I think when you design the rules just for the biggest incumbents, you create problems. So we are generally taking a new approach to regulating. We're looking more at how do you promote a competitive, decentralized market structure? How do you make sure that middlemen and gatekeepers don't get to eat a big part of the pie? And ultimately, how do you create rules that promote switching and shopping?
And obviously, you're still in the middle of this process. Or you think that ultimately the data, I mean, we're talking about access to credit, right? Particularly to families who need it most, right? Who are getting cut out of the system. Do you think the data will prove that out as you continue to get more of it in?
Well, we'll see. I mean, I think in some ways the experience in other global jurisdictions is that I think many people anticipated a big boom in people getting access to credit that otherwise wouldn't have. I'm not sure. We'll see. I do think a big benefit will be helping the financial services industry be less reliant on credit scores. I think credit scores, those of you in the lending business know, you have to do your own supplementary credit underwriting almost, because those credit scores are often unreliable, inaccurate, or in many cases, people won't even have a credit score. So I think when we set forth the ability for people to permission their financial data on their bank account, their P2P app account, more lenders are going to get insight on cash flow, what's coming in the account and what's leaving. That's going to give people insight on residual income, which really is in some ways going back to the basics of banking, of seeing how much money does someone have left in order to service some sort of new loan or financial obligation. So I'm hopeful, but we'll see. We'll see how much that data is going to be used for that purpose. I do think that we will be able to at least give consumers the ability to threaten to switch more. Take a look at after the Fed has raised interest rates, very quickly in recent quarters, the biggest banks have not really passed on any of those rate hikes to depositors. You're barely seeing it budge. So the more consumers have the ability to credibly threaten a switch, I do think that could help us, help consumers capture more of those deposit APYs and ideally get lower costs on their loans as well.
So you beat me to the punch. The Bureau is collecting data on the role of artificial intelligence in underwriting, where obviously the benefits and the concerns in AI in lending decisions. Are you able to share some insights into what the Bureau is looking at or monitoring in the field?
We generally find artificial intelligence to be a nebulous marketing term. I think I've shared with some of you in the past that finance has always used, automated decisioning in some ways, advanced computational methods, big data sets. We're now just in a new iteration of that where the public has more visualization about it, and especially when it comes to generative AI. The creation of content, videos, audios that might simulate human interaction. So I often challenge the team to think about what might banking in the metaverse look like? How would it change human interaction? And a place we're trying to be very crystal clear on is that your artificial intelligence, or whatever you want to market it as, if it's giving false information, if it's violating the law, you have to take responsibility for that. You can't have your chatbot, lie to consumers. So I think that's part of it, but there's more to do there. Ultimately, we want technology to have meaningful human progress in how they can achieve their financial dreams and not be used in a way to essentially cheat or scam people.
Let's shift a little bit. as the director of the CFPB, you have a seat on the FDIC board, and so you kind of have a front row seat to what's happened over the last few months. Can you talk a little bit about what you see and ultimately how you think maybe potentially fintech and regulatory modernization could be helpful to solve some of the problems?
Well, yeah, if you rewind to early March, on the same day, you saw the announcement of the self-liquidation of Silvergate Bank, essentially a bank that was deeply tied to the crypto asset ecosystem, and also an announcement by Silicon Valley Bank that they had sold a lot of long-dated securities and taken a big charge, and they were going to raise capital within a day. Silicon Valley Bank lost over $40 billion in deposits. Most of it was uninsured deposits that are very flighty. And we saw the failure the morning of SVB on that Friday. Across the system, you saw uninsured depositors run. That weekend, we closed Signature Bank, which also had some exposure to the crypto asset ecosystem. First Republic was under a lot of stress as well. They did get a big deposit from the big banks that ultimately just delayed what I think was inevitable, their own failure. So there's a few things. One, that we have taken steps, in some ways emergency steps, to stabilize the movement of deposits. I think those emergency measures were very important, and I think we want people to have confidence that their deposits are safe. I think as it relates to open banking, though, you're starting to see people say, wait a second, if we have a more frictionless open system in banking, is that going to make deposits move even more? And my response to that is usually, let's just accept the fact that communication is going to be faster and that friction is going to go down. That's a good thing. And let's adjust our bank regulatory system when it comes to capital. That's the skin in the game that the shareholders have, liquidity, the cash on hand that they have to meet deposits. Let's make sure that that's right-sized for the 21st century. So I don't want these bank runs being used as an excuse to slow down open banking.
Again, it sort of nicely goes into the speed of money movement, right? And the U.S. Treasury released a report focusing on the future of payments that includes a series of policy recommendations. And one that the U.S. promote responsible payment innovations. I think that's critical. The faster we can move money, obviously there's more ripe for potential issues like fraud and how money is moving and who's ultimately responsible for that. And so how do you see the CFPB looking at that with the creation of FedNow and other things in terms of regulating to protect the consumer?
Yeah, I think payments and future of money is really one of the most, we're at a big point right now of determining what the future looks like. If you just saw what happened in the past few months, very early after the failures of SVB and Signature, I think you saw $700 billion move from banks to money market funds. I think you saw, for those of you who know it well, the Fed's repo facilities. That's a big vector for how money is now moving. And also, we saw that there's more different types of ways in which people are transacting. Obviously, stable coins and other digital payments are very clearly in focus. A place the CFPB is looking at a lot is P2P apps. After the failure of FTX and obviously these bank runs, I think many people are rightfully thinking about, is the money that I have stored in my Venmo or Cash App account, is that insured? And actually, in many cases, it's not. I want to make sure that when people think that their payments are stored in a deposit-like account, that they have some confidence that it's truly safe. So we have argued that we may need to do some things in order to give people that confidence. FedNow, other ways in which real-time payments are occurring, we're just going to see more and more of it. And we'll need the industry and others and the regulators making sure we deal with the consequences and rein in the fraud, rein in some of the negative effects. But ultimately, I think a world where people can move money more quickly, when low-income workers can get paid every day at the end of their shift, that's something that can be very meaningful and one we should really push toward.
And so I'd be remiss if I didn't ask. I come from a background in state government. I served in the state legislature here in New York. Can you talk about how the CFPB interacts with state governments and state regulators? In the absence of legislation or meaningful change in Washington, oftentimes states take it upon themselves to create consumer protections. Can you talk about the CFPB and particularly how you interact with big states like New York or California who are going to take the lead on some issues if no one else is acting?
Yeah, we talk to all of them, and I think a big thing that is important about, we don't feel we have some sort of monopoly on consumer protection. And actually, even if we failed at our job and didn't enforce the law, didn't carefully steward the law, we have a good backup force there. And we encourage those states to bring actions. We encourage them to create the right type of licensing regimes, to create the right type of ways to give consumers confidence and to not allow fraudsters to infect the system. I'll give you an example of a place where we're really looking and talking to the states about shifting, and it relates to those P2P apps. Many of them are licensed as money transmitters, essentially sending a remittance to a family overseas, not really intending to store sometimes billions of dollars for a long period of time and have a deposit-like account. We obviously talk to them a lot about stablecoin, buy now, pay later. Many of them are trying to think about how they create the right type of oversight too. So I actually think that's a good thing because we're helping also to make sure that maybe it doesn't conflict or how it works with the federal rules. And we certainly encourage the state financial regulators to bring actions against bad actors.
Well, I can say that everybody in this room and everybody at this conference is excited about financial innovation. And we're even more excited to work with our regulators to ensure that we're able to do it without compromising on consumer protections or regulatory compliance. And so we thank you for your partnership, for your continued willingness to work with us, and look forward to continued conversations.
Well, we also want to make sure that innovation is really about human progress. And I think that's where many of you will ultimately face some tensions when it comes to, an environment where people may be looking for exits, people may be looking for what's next. And I think ultimately, if you have strong consumer protection, strong laws, you'll allow yourself to steward your firm in a way that you maybe originally envisioned it to, with the optimism and the idealism that you have. Too many firms who talk about how they're innovative, end up cutting corners or violating the law. And, that's something you want to make sure that there is strong rules of the road so that there can be high levels of confidence and that innovation can be mapped to human progress.
Well, excellent. Thank you so much for joining us, and thank you, everybody,
again
for joining.